Hi everybody. A very exciting moment in the life of a company is always an M&A transaction. Now I would like to give you a little bit of the basics of M&A transactions in the Netherlands. And let me start by saying that probably the timing is very good because the baby boom generation is aging, is retiring, and a lot of those people actually do not have successors. They may have hoped that their sons or daughters might step in their footsteps, but very often they want to become a doctor, or they may go overseas, or whatever reason they are not taking over the business of their parents. And so those businesses, very often interesting businesses of the right size with interesting products and market reach, are for sale. And since interest rates have been going up recently, I don't have to explain to you what the impact of that is. It means that prices are coming down. So the timing is right. So if we talk about M&A class 101, well, there are two forms of an M&A transaction, as you all know. It's either an asset deal or a share deal. An asset deal is better for the buyer, a share deal is better for the seller. In all honesty, the market is normally dominated by the wishes of the seller, so we see a lot more share deals than asset deals. Share deals, on the face of it, are simpler, but the legal work is actually more complicated. Let me start with going quickly through an asset deal, which is better for the buyer. Why? Because it's basically a clean slate. You set up your own new company and you take over the assets of the seller, and only the assets that you like to take over. In principle, you buy the assets that you like. You pay for the goodwill, and the interesting thing is, if you do an asset deal, you can actually amortize the goodwill, typically in 10 years' time. And that applies to all the assets, even though an asset that might have been basically written down already to a base residual value by the seller. If you buy it and you can allocate a fair market value which is higher, then you start amortizing on that higher fair market value, depending on the economic life of that asset, maybe in 3 years or 5 years or perhaps 10 years amortization period. Something to keep in mind of if you're planning to use debt funding is a European rule on thin capitalization. So your interest is not deductible if it exceeds 20% of your EBITDA. In today's law, there's a threshold for the first 1 million, so SMEs are basically not touched by that rule, but there's a proposal pending to eliminate that 1 million threshold, which especially in real estate businesses is a real nightmare, but it impacts all SME transactions, so that's something to follow carefully. Like I mentioned, it's good for the buyer. You don't have the risk of hidden corpses in the closet. You start with a clean slate, but the seller will probably counter your offer and say, hey, but if I do an asset deal with you, that means that I have to pay tax on the goodwill and all the capital gains that I realize. Time value of money disadvantage. For you, it will take time before you've recuperated that amount of tax. So together, we're basically paying tax up front. We're accelerating paying tax, and that's why most transactions end up being a share deal. But in the case that the seller has NOLs, for instance, and net operating losses, it may be very useful to do an asset deal, and there may be other considerations to do an asset deal as well. If we talk about the share deal, then obviously there is no goodwill deduction. You will be paying a premium, but that premium, because it's a share deal, you can't do anything with that premium from a tax point of view. You're basically buying the shares, and in the Netherlands we have participation exemption. That means that 100% of your capital gains or capital losses and 100% of your dividends are free of tax. It's outside the scope of taxation. Capital gains, dividends, no taxation. But that also means that you get no benefit for any goodwill that you're paying. Be careful when you're buying a running company. Normally the net operating losses should be preserved, but those rules are fairly complex, so you must be sure that you don't risk losing those NOLs, because you will typically pay for it, so it would be a shame if you couldn't use them. In the case of a share deal, typically the acquisition structure is more complex. We typically set up a Dutch holding company that then acquires the target, and in the Netherlands we have the concept of fiscal unity. That means they basically consolidated for tax purposes. That means that the holding company must acquire at least 95% of the shares legally and economically of the target company. And then you can offset any expenses like interest expenses, for instance, in the holding company on acquisition financing against operating profit of the target company. Again, those rules are fairly complex. I won't go into them here, but talk to your advisor if you go that route. I already mentioned the thin cap rule, the 20% EBITDA restriction that applies here as well. Of course, there's another rule. It's more a basic erosion rule, Article 10A, a tricky rule. It's best to talk to your advisor about it. But I mentioned in the beginning that it may seem simpler as a transaction, a share deal, but actually, if you go to the nitty-gritty details, these type of rules make it quite often more complex. As a general rule, bank debt is easier to deal with than related party debt, which obviously should meet the at arm's length standard. And I would say, please make sure that you involve your advisor early on, when you're getting bank debt, or especially when you're getting bank debt, because there's some things that he will be able to help you with. Now, the Netherlands doesn't levy withholding tax on interest, so that makes things a bit easier. Let's talk about the process. I already mentioned, please involve your advisor, and that's not because of our own activities, but I sincerely mean that. Make sure that you have an experienced and independent thinking advisor who understands your economic and commercial objectives. I can give you an example of a hotel deal I was involved in recently, where the client went ahead, did the transaction basically already, and then asked for our advice. It was a share deal, even though he thought he was buying a hotel. The hotel was in the books of the company for 2 million. It had a fair market value of 6 million. So there was a latent gain of 4 million. So basically 1 million of latent tax liability that he never bothered negotiating with the seller. So the seller had a very good transaction there. Any tax advisor would have prevented that from happening. The advisor will help you in your negotiation, and a good negotiation hurts on both sides. That's part of it. After the negotiation, the due diligence process starts. That's basically the same in any country, of course. Especially for people from outside the EU, you have to consider the risks involved in value-added tax. In theory, value-added tax should be neutral for the entrepreneur, but that's only in theory. So especially for DD purposes, you should really pay attention on VAT. The same applies for wage tax. There are all sorts of special exceptions, special rules that the seller may not have really monitored very carefully, and then during the DD we will bring them out and highlight them to you so that you can then renegotiate the purchase price. Another element is the supply chain that you want to review. We have a lot of experience at Blue Turtle with supply chain planning, and the last point of the DD are the treaty positions, the tax treaty positions, which nowadays are much more sensitive than they used to be. So then after the DD you go to closing, you have your post-closing adjustments, and then you have your integration, and then you should start operating the entities together. Obviously, the effective date is always a sensitive point, so that's also something in which we will help you manage. Just a few basics on taxation in the Netherlands that is relevant for an M&A transaction. The Dutch legal system is very different from the Anglo-Saxon legal system. Our legal system is based on the Code Napoleon, the French legal system. In civil law systems, the standard of reasonableness and fairness is very important. So we may not write out everything, but a judge will always apply this reasonableness and fairness. So that's why you sometimes will see contracts that are not as elaborate as contracts drawn up by American lawyers, for instance. The other important thing is the Dutch ruling system. Our tax rates are low rate of 19% and the higher rate of 25.8% that applies for profits over 200,000 euros. If you have innovative business, there's a special rate of 9%. Interest royalties, management fees are typically tax deductible, and typically there's no withholding tax. Obviously they should meet the at arm's length standard. Net operating losses can be carried back for 1 year and carried forward indefinitely, but over 1 million, only 50% of your profit can be set off against the losses. And there's a new OECD development on called Pillar 2 that introduces a minimum tax rate of 15%. On an international M&A transaction where, for instance, you're acquiring a company with subsidiaries in various European countries and beyond, you need good coordination. Your purchase price allocation becomes very important. How do you allocate and manage the debt funding and the equity funding? What is your repatriation strategy? Again, a Dutch holding company is the standard answer. If you only have a foreign deal, so basically not a Dutch deal, then I would say your old-fashioned treaty shopping doesn't work anymore. A platform structure can work, but most of the time we will then go to bespoke solution, which really requires a one-on-one conversation with one of our advisors. I hope this has given you an introduction to M&A in the Netherlands, and obviously we're here to help you.